how do you decide to go into something specific, so specific as lending technology?
For sure. Great question. It was definitely an evolution. Going back to the early days, I kind of grew up and I always wanted to be an entrepreneur. My dad was a serial entrepreneur and I wanted very much to follow in his footsteps. And I had several business ideas in high school and college that almost got off the ground to become a real business. But in my senior year of college, my dad came back and told me about a meeting he had with his elder law attorney. And the elder law attorney was complaining about having to review 60 months worth of financial statements for every single long-term care Medicaid application. So my dad kind of said, like, this process doesn't make sense. What do you think of this? And me and my business partner, a guy named John Gersey, who was my high school buddy that we always worked on entrepreneurial things together, we didn't know anything about Medicaid or document processing, but we were interested enough to investigate the problem further and try to understand, is there something there? So it really started as a research problem. We then had the idea to build an automation solution for elder law attorneys investigating bank statements. And one thing led to another. We recognize that the same foundational technology could be applicable to other use cases such as lending. And in 2016, as we were getting our product off the ground and getting our first paying customers in, we made the decision to really pivot the business, focus on the lending business, and that's what we've been building for the last, 9+ years.
And to get into these markets is not easy. With lenders, I mean, you're dealing with potentially certain regulations. You're dealing with maybe a market where folks are very experienced and maybe unwilling to trust new technologies. How challenging was it to get into the lending space?
Think, what you're describing is actually one of the reasons that it was an opportunity for us. The technology behind reading documents has always been imperfect. In the early days, it was OCR, optical character recognition, that evolved into intelligent document processing, and then, computer vision models, now large language models and specialized language models, and like the technology keeps progressing. But even today, there is no technology that can read every document with perfect accuracy. And back in the day, when we were starting, the technology was, call it 70, 75% accurate. And because it was so inaccurate, lenders could not use it to make
Mm.
decisions. So we recognized that, and we recognized the scrutiny that lenders required around accuracy and compliance and completeness and thoroughness. And we viewed that as an opportunity. Our early wedge in was reading documents with machines, but also using a human in the loop verification service so that every time we gave back data to the customer, it was over 99% accurate and they could use it for a high stakes decision like a small business loan or a mortgage loan. And that was a huge differentiator for us. The other competitors on the market were machine only competitors that could only do 75% of the work. They then had to defer all of the burden of the data cleanup and the data entry back to the lending customer, and that was not a sufficient product offering. So we tried to take that compliance angle and turn it into our favor by focusing on completeness. The completeness allowed us to do a few things that really leapfrogged the company to the next level. One is because we produced perfectly accurate data, we could then run a series of analytics on top of the data to help with decision making. So in small business lending, for example, the lender wants to understand what's the revenue of this borrower, what's the debt capacity, what's the gross margin, what do seasonal cash flows look like. You cannot run that type of analysis on a 75% accurate foundation. So because we did the human in the loop, we could then get into this analytics layer. The other piece that's really critical is we in the background we're creating data labels, right? So we created perfectly accurate data for our customers, but we also had this meticulous data labeling operation where we had the answer key. We knew the exact right answers for all the bank statements we processed. So we started building a feedback loop to train our models to get smarter and smarter. And today that's one of Ocrolus's great technology advantages is we can take the best available models and fine tune them with Ocrolus training data to achieve superior machine accuracy on complicated documents like bank statements and pay stubs. So long-winded answer, but we saw the compliance issues and we tried to turn that into an opportunity and it really set the company on a great path.
Can you tell us about the types of loans you're analyzing? Are these all, kind of business loans or are there consumer loans in there? And among the businesses, are there certain types? I mean, I would imagine it gets harder to analyze, more, maybe certain types of businesses.
Totally. So we really made our name in the business lending market. Broad strokes, there's about 35 million businesses in the country. 10 million of the or so of them are smaller or newer businesses that don't have robust credit history. So think about new LLCs that are formed, or pizzerias, or nail salons, or florists, or Main Street businesses. If you're a large business, you can go to a bank and get a commercial loan. If you're a small business, the bank often won't serve you because it's very difficult to underwrite you because you don't have a robust history of being in business. The leading small business lenders were firms like Can Capital and On Deck that emerged in, call it, you know, 2010 or so, and really built this category of small business lending over the last 15 years. And when I refer to small business lending, I'm talking about, $1 million below ticket size is typically the ballpark. Let's say it's an average ticket size of 75 to 100,000 bucks.
Hmm.
So these types of lenders, because there is not a robust credit history, they rely on cash flow based underwriting. The way that they do underwriting is they read your bank statements and they try to understand all of these different metrics, and they basically build up a P&L statement based on your bank statement data. So that was our entry point, right? Like the original product was bank statements for elder law attorneys. We realized, hey, doing bank statements for small business lenders is very, very similar. But there's, really great combo of short sales cycles, high average customer value. And as I mentioned, we started building out all of these analytics to help really understand the dynamics of a business's financial health. So that was the focus of the business from 2016 up until 2021. And we built a really, I'd say a market leading technology in underwriting automation and cash flow analysis for small business lending. In 2021, we went to the markets, started chatting with VCs, and we said to investors like, hey, look at this business that we've built in small business lending. Give us some cash and we can replicate our success in an even larger market, which is mortgage lending. So in 2021, we started building out the product to handle the mortgage process as well. I'm not sure if you've gone through a mortgage, but it's an insanely document intensive process where the lender will ask you to submit bank statements and pay stubs and W-2s and a long tail of tax documents and appraisals. And, there's a binder of information that's required in the mortgage process. So it was a perfect opportunity for Ocrolus. Same foundational technology, reading documents with perfect accuracy. In small business lending, the lender needs to understand revenue. In mortgage lending, the lender needs to understand income. That can be pretty straightforward if you're a W-2 employee with one job. It's a lot more complicated if you're a non-traditional borrower. If you have seasonal salaries, commissions, bonuses, overtime pay, you have rental properties, you're a personal trainer, you're a gig worker, there's something like 35 to 40% of Americans have some non-traditional elements to their income profiles, which makes it difficult for the lender to do this kind of work. So we built the mortgage product starting in 2021. The other awesome thing about building the mortgage product and the income suite is if you think about all of these other categories like personal loans, auto loans, rental applications, etc., they're kind of like a subset of the mortgage. Like the mortgage is the full deep analysis, but these smaller consumer credit products, they also rely on income verification and calculation technology. So fast forward till today, the two drivers of our business are small business funding and mortgage, but we also do serve customers across consumer personal lending, auto lending, rental applications, etc. Today the company has about 450 customers, financial institutions, fintech customers across these categories, and we analyze something like 750,000 credit applications every single month.
And so, how dynamic is the pricing, the interest rate that gets charged, to the borrower? Um, is it highly variable based on your analytics?
I would say it's variable based on the lender and where they sit in the stack. Our role is to take a lot of cost and inefficiency out of the process. So we are a B2B company that serves lenders, but our ultimate value is helping the small business owner or the mortgage borrower get access to capital faster and on better terms,
Hmm.
right? On the small business side, like often it's an emergency, right? Like your pizza oven goes out and you need to serve customers and you need to buy a new pizza oven. Like you need that cash to be able to stay in business. And having a lot of inefficiencies in the underwriting process is what ultimately makes the cost higher for the end borrower.
Hmm.
So if we can streamline this part, A, we get the borrower cash faster because the decision happens faster. But B, over time, we can start to take costs out of the system, and the goal is to reduce cost for the end user of the platform. Similarly, on the mortgage side, like, again, the average time to get into a house, it's something like, 50 to 60 days. It takes 2 months to close a mortgage, which is absolutely insane. The market leaders, the tech forward players in the space can do this in 20 days or less.
Mm.
So our job is to go out to the financial institutions, the banks and lenders and say, hey, look at your process today. It's 50, 60 days. Like if you implement Ocrolus and other key technology across the stack, you can shave this down to 20 days or less, which results in, much stronger borrower experience and retention.
Hmm. And what does your relationship with your clients look like economically? Is it like an enterprise, um, agreement subscription? Is there volume based? Is consumption pricing? How does it work?
Yep. So we are consumption-based, outcome-based pricing, pay per use. Essentially, the customers pay us per application. Typically, a customer will commit to a certain amount of expected applications throughout the year. They typically commit to something like 50 to 75% of the volume that they expect. And then anything they do beyond that, they can pay us on demand on a per unit basis. It's a great structure because it directly aligns our value with our customers growing their business as they grow their origination volume and lending activity. Our costs scale with them. And I will say that, we have been preaching artificial intelligence in underwriting for years and years. You can find us find banners of us at conferences in 2017 with headlines that say power your underwriting with artificial intelligence. So, back in the day, we used to get dinged for this pricing model because investors would say to us, hey, isn't this why isn't this subscription SaaS and this is more volatile and blah blah blah. And that is true and had some merit to it. But fast forward, I think since the rise of generative AI and the general push in AI, I think the world is coming around to this concept of consumption-based, outcome-based pricing that we were, ahead of the curve on.
Can you tell us a little bit about how your volume has scaled over the years?
For sure. I mean, early days, like I was the company's first verifier. A document would come in, we'd read it with OCR, I'd key in data and try to try to make it as accurate as possible. I'd click submit, and within 48 hours, it would go back to the customer. So in those days, when it was myself and then a couple employees in our New York office, we started in Long Island in Glen Cove, in believe it or not, in a basement office underneath a barber shop. So we were keying in data, and when volume came in, it just meant it was going to be a longer night at the office to try to churn through this. I remember we raised our first institutional round, our Series A round in January 2018. We closed it, and in mid 2018, it was the summer of 2018, we hit a milestone, which was it was the first time we did 1 million pages analyzed in a month. And we thought it was like the biggest number ever. We were so pumped about it. And we threw a party. We called it the 1 million page party. And we threw it at the one hotel in Brooklyn. And we went out to Brooklyn. We took everybody out. I think there was maybe 15 team members at the time on the corporate team. And we celebrated the 1 million page milestone. Fast forward till today, we recently launched a contest for all Ocrolus employees to guess what will be the first day where we analyze 1 million pages in a single day.
Mm.
And we are knocking on the door. We actually just the other day had a day where we did 998.5 thousand. So it literally could happen today. It could happen any moment now, but that hopefully gives you some sense of, from early days to doing a million pages in a month to now doing a million pages per day.